A business owner once told me something confidently. I don't charge VAT because my customers won't pay. 6 months later, the tax authority didn't ask whether his customers were happy. They asked one simple question: did you collect VAT on taxable supplies? Today, let's talk about VAT. Not the Instagram version, but what VAT really means under the Nigerian Tax Act of 2025. Welcome to Most Brief, where we break down finance into simple practical steps. My name is Mara. The plain truth is VAT is not your money. The moment you collect it, you are holding government money in trust. So the danger is not only not on charging VAT, the danger is in charging it wrongly or not knowing where you're supposed to charge it at all. And this is where many businesses go into trouble without realizing it. Now, what is VAT? In simple terms, VAT means value added tax. It's a consumption tax, not an income tax. That means it is tax on value consumed, not on who is rich or who is poor. If value is created and consumed in Nigeria, then VAT is interested. So businesses collect VAT, government receives that VAT through businesses, and the final consumer bears VAT. VAT rate in Nigeria is still 7.5% and is applied to taxable supplies of goods and services. The rate sounds simple, but what is taxable is where the real conversation is. So what is taxable supply? Let's explain it. A taxable supply simply means a good or service that the law says VAT can be charged on. So this includes goods you sell, services you render, digital services, imported services, services provided by non-residents but consumed in Nigeria. If you provide value and you charge money, assume VAT applies until the law clearly says otherwise to be protected. So what are the supplies that are really exempted? Now let's talk about exempt supplies, because this is where people misunderstand VAT. What does exempt mean? Exempt means VAT does not apply at all. So example is basic food items, unprocessed, medical and pharmaceutical products, educational services, books and learning materials. Now, if your supply is exempt, you do not charge VAT. You cannot claim VAT on your cost either. Exempt does not mean better. It means VAT stays completely out of the transaction. Zero rated supplies. Now, this is the one many people don't understand. Zero rated supplies. What does zero rated mean? Zero rated means VAT applies but at 0%. Most common example is exports. The key difference is you charge zero rated, you can still recover your input VAT. And I'll explain this further when I talk about input and output VAT. So let's be very clear about what is not exempt, because this is where assumptions, destroy businesses. No exempt. What is not exempted? You see, consulting services, tech and digital services, fashion, beauty, lifestyle, brands, all not exempt. Online subscriptions, logistics and delivery, commercial rentals, content creation and digital platforms. If you earn from skills, services, or digital value, VAT is almost always involved. So let's also look at what triggers VAT in the first place. Under the Act, VAT becomes due at the time of supply, which is the earliest of. There are different reasons. When an invoice or receipt is issued, when goods are delivered or made available, when payment is due or received. Whichever happens first is what counts, not when cash finally entered your hand. So who remits VAT? Number one, regular businesses, suppliers. You collect VAT from your customer, you remit to NRS. I'm still getting used to it. On the following month, these ministry departments and agencies are appointed withholding agents. So they withhold VAT from your invoice, they remit directly to NRS on your behalf. Input VAT, now this is VAT paid. This is the VAT incurred by a business on taxable goods purchased or imported directly for resale, and on services or overhead used for businesses operations. The 2025 Act expands the ability to recover input VAT on services and even fixed assets, which was more restricted under the previous regulation. Output VAT, now this is VAT that you charge. This is the 7.5% tax added to the value of taxable goods and services that you sell as a business, or you rendered a service or invoice to client. It must be collected and remitted to NRS, not FRS. Then you now have the net VAT. This is either payable or a refund. So you remember businesses calculate the net tax by subtracting the total input, that's what you paid, from the output which you collected. If output is higher, the difference is remitted to NRS. If input VAT is higher, then the business can claim refund or credit against future liability changes in this 2026 is that the new law adopts a broader input VAT recovery. So it allows businesses, including service providers, to claim input VAT on virtually all business-related expenses, things like rent, utilities, provided they are for taxable supplies. So this is one of the advantages of the new tax law. So what are the practical steps as a business that you need to start? Step 1, know your VAT status. Don't assume, always confirm. Number 2, separate VAT from revenue. VAT is not your money. If VAT enters your main account and you forget it's not yours, you will spend it. Step 3, issue proper VAT invoices. This is now compliance, not courtesy. Step 4, remit VAT on time. VAT collected but not remitted is treated like debt. So it's better for you to remit on time. In conclusion, even though VAT is a consumption tax, it's not meant to, frustrate businesses. What really causes confusion or problem is wrong assumptions and poor structure. If this helped you see VAT as more than just 7.5% like the video, save it and share it with people would benefit from this regarding running of their business. The next episode, we're going to talk about company income tax the same way. And if you have any questions regarding VAT, especially that input and output VAT, please you can send your question through the comment section, and we can talk about it and discuss it. Thank you, and remain financially fabulous. Bye.